Congratulations! If you're listening to my voice right now and you're still holding your physical silver, you have survived one of the most vicious, coordinated, and desperate psychological attacks in the history of financial markets. You have watched the price plummet for no reason. You have watched the mainstream media mock you. You have watched the so-called experts declare that the silver squeeze is dead. And you are still here. You are still standing. Ladies and gentlemen, Asian guy here known as John Ben from Currency Archive. I know the comments section is on fire. I see the critics. I see the people saying, Asian guy, you were wrong. The price dropped. You promised us the moon and we got a red candle. To those people, I say, you were looking at the waves, not the tide. You're looking at the paper illusion that the banks are painting for you. And you are missing the tectonic shift that is happening beneath your feet. They want you to be angry at me. They want you to be angry at the movement because if you are angry, you will sell. But the fact that you haven't sold, the fact that you're still seeking the truth, means that their manipulation has failed. They tried to shake you out and you held the line. That is not just stubbornness, that is victory. Just remember, papers lie. Look at the physical price everywhere. What I'm about to show you today proves that everything we have been talking about, the shortage, the leverage, the desperation, is not only true, it is accelerating. We are not just in a squeeze anymore. A squeeze implies a temporary pinch. What is happening right now, starting with the opening bell of 2026, is a takeover. It is a hostile takeover of the global silver market by the Eastern Hemisphere. The West is selling paper, the East is taking the metal, and if you are holding physical silver, you are on the side of the takeover. You are on the winning team. So let the haters talk. Let the paper traders cry about their stop losses. We are playing a different game. We are playing for the future of the monetary system. And the first piece of evidence, the smoking gun that proves this is a takeover, and not just a trade, lies in the connection that the mainstream media is terrified to report. It lies in the relationship between the green energy narrative and the red dragon. We need to talk about the solar chokehold. For the last 5 years, you've been told that the demand for silver is rising because of solar panels. That is true, but what they didn't tell you is who controls those panels. As of late 2025, the People's Republic of China controls over 80% of the entire global manufacturing capacity for solar panels. Let that sink in. 80%. The United States, Europe, and Japan combined control less than 20%. Now think about the physics of a solar panel. You cannot build one without silver paste. It is the conductor that turns sunlight into electricity. So, if China controls the factories, China controls the demand. And do you think China is going to let the silver they need for their energy dominance leave the country just because JP Morgan smashed the price on the COMEX? Absolutely not. We are receiving intelligence reports verified by multiple sources on the ground in Shenzhen and Shanghai that the Chinese government isn't just buying silver. They are weaponizing it. They have quietly implemented the strictest export controls we have ever seen. They are keeping the metal inside their borders. They're effectively telling the West, if you want solar panels, you buy them from us, but you're not getting our silver to build your own. This is a blockade. It is a resource wall, and it creates a bifurcation in the market that is impossible to hide if you know where to look. You don't have to take my word for it. You just have to look at the Shanghai premium. This is the number that the arbitrage algorithms are screaming about. Right now, as I speak to you, the price of physical silver on the Shanghai Gold Exchange, the SGE, is trading roughly $7 higher than the price on the COMEX in New York. $7. Do you understand what an arbitrage gap of $7 means in a normal market? It is free money. In a functioning market, a trader would buy silver in New York for $71, fly it to Shanghai, sell it for $78, and pocket the difference. The gap would close in hours, but the gap isn't closing, it is widening. Why? Because the metal cannot leave New York fast enough. Or more accurately, the metal in New York doesn't exist in the quantities they claim. The arbitrage of the century is sitting right there, staring us in the face. It tells us that the real price of silver, the price paid by the people who actually make things, is nearly 10% higher than the fake price shown on your trading app. This spread is the smoke alarm. When the kitchen is on fire, the smoke alarm goes off. The Shanghai premium is the alarm. It is telling you that physical metal is draining from the West. It is leaving the vaults of London. It is leaving the vaults of New York, and it is flowing east into the black hole of the Chinese industrial complex. The Chinese are happy to pay the premium, because they know the paper price is a lie. They are draining the West of its real wealth, while the West plays games with paper derivatives. So when you see the price drop on the COMEX, do not despair. Realize that every drop in the paper price just makes the arbitrage more profitable. It accelerates the drain. It is like a store lowering the price of bread during a famine. The shelves will clear instantly, and that is exactly what is happening. The West is going out of business, and they are putting their inventory on clearance sale for the East. But the solar chokehold and the Shanghai premium are just the economic side of the equation. There is a darker, more volatile force at play that is keeping the floor under this market. Because while China is securing the energy transition, the rest of the world is lighting a match near a barrel of oil. We have to talk about the fear trade. We have to talk about why the price won't stay down no matter how hard the banks hit it. We have to talk about the geopolitical firestorm involving Venezuela, Nigeria, and the US Navy that is forcing money into safe havens. Let's look at the war bid. Let's look at the macro reality. And this is where the story shifts from simple supply and demand to something much more visceral, something that hits you in the gut. Because while the bankers in New York are playing their video games with paper contracts, the real world is catching fire. We are seeing a convergence of geopolitical crises that we haven't witnessed since the 1970s. And this firestorm is creating a floor under the silver price that no algorithm, no margin hike, and no central bank intervention can break. We call it the war bid. You have to look at what is happening in the energy markets right now, specifically in Venezuela. For the last 48 hours, the news has been filled with reports of United States naval assets tightening the blockade around the Venezuelan coast. They are intercepting tankers. They are enforcing sanctions with a level of aggression we haven't seen in years. Why? Because Venezuela is trying to sell its oil for UN, as we discussed. But the market interprets this blockade not just as economic policy, but as an act of war. It is a flashpoint. Every time a US destroyer stops a tanker in the Caribbean, the risk premium on every single commodity spikes. Oil spikes, gold spikes, and silver spikes. But it isn't just Venezuela. Look at Africa. We are receiving confirmed reports of massive coordinated strikes across the oil fields of Nigeria. Nigeria is the largest oil producer in Africa. When you take Venezuelan heavy crude offline with a blockade, and then you take Nigerian light sweet crude offline with a strike, you create an energy shock. And history teaches us one undeniable lesson. When energy prices rise, silver prices rise. It is a direct correlation. Energy is the primary cost of mining silver. If diesel fuel for the excavators costs more, the silver costs more. But more importantly, energy shocks create inflation. They destroy the purchasing power of the dollar. And when the dollar starts to burn, the smart money runs to the fire exit. That fire exit is painted silver. This is the fear trade that the mainstream media is ignoring. They want you to believe that silver is dropping because inflation is under control. That is a lie. The smart money, the sovereign wealth funds, the family offices, the hedge funds that actually know what they're doing, are buying silver right now because they are terrified of a hot war. They see the blockade in Venezuela. They see the chaos in Nigeria. They see the tension in the South China Sea, and they know that in a world on fire, a piece of paper that promises to pay you dollars is worthless. A digitally printed currency backed by a government that is $35 trillion in debt is a liability, not an asset. So they are dumping paper and buying metal. This is why the price refuses to stay down. Have you noticed every time the banks smash the price to $70, it bounces right back up to 72 or 73? It is like trying to hold a beach ball underwater. The moment they take their hand off the ball, it rockets to the surface. That buoyancy, the refusal to crash, is the war bid. It is the geopolitical floor. And this floor is what terrifies the banks. In a normal market, they could smash the price to $50 and keep it there for months. But in this market, if they smash it to $50, the fear buyers will devour the entire inventory in an afternoon. The war bid puts a limit on how much they can manipulate the price. They are trapped between a rock and a hard place. The rock is the China solar chokehold that we just talked about, the physical shortage. The hard place is the war bid, the monetary panic. They cannot let the price go up because they are short. But they cannot push the price down because they will lose their inventory to the safe haven buyers. So what do? What is the only option left for a cornered animal that is bleeding capital and running out of time? They have to cheat. They have to change the rules of the game in the middle of the fourth quarter. They can't win on supply. They can't win on demand. So, they attack the mechanics of the market itself. They attack your ability to hold the position. We need to talk about the dirty trick. We need to dissect the nuclear option that the CME group just launched against retail traders. Because if you don't understand this, you will look at your account balance and panic. You will think the market is crashing naturally, but it is not natural. It is engineered. Let's look at the margin nuke. Let's look at exactly how they are trying to force you to sell your winning lottery ticket for pennies on the dollar. They deployed the margin nuke. Let me explain exactly what happened, because unless you are a professional futures trader, you probably missed it. And that is exactly what they counted on. In late December of 2025, the exchange quietly announced that they were raising the initial margin requirement for a standard 5,000-ounce silver contract. They raised it from roughly $21,000 to $25,000 per contract. Now to the uninitiated, this sounds boring. It sounds like technical mumbo-jumbo. Oh, they just raised the deposit a little bit. Who cares? You should care, because this little bit is the difference between survival and liquidation for thousands of traders. You have to understand how the futures market works to understand the malice behind this move. The COMEX is a casino built on leverage. When you buy a silver contract, you don't pay the full value of the metal. A contract represents 5,000 ounces. At $72 an ounce, that contract is worth $360,000, but you don't put up $360,000. You only put up a good faith deposit, the margin. Before this week, that deposit was $21,000. That gave you massive leverage. You controlled $360,000 of silver for just $21,000 of cash. It is a ratio of roughly 17 to 1:1. But then the exchange changed the rules overnight. They said the price of poker has gone up. If you want to stay at the table, you now need to put up $25,000. That is a 20% increase in the cost of holding the position. Imagine if you had a mortgage on your house, and the bank called you on a Sunday and said, "Hey, we decided to raise your down payment retroactively. You need to wire us another $4,000 by Monday morning or we are taking the house." That is exactly what just happened. So what happens to the retail trader who was maxed out? What happens to the guy who had $100,000 in his account and bought 5 contracts using nearly all his cash for the margin? Suddenly he's in a deficit. He gets the dreaded phone call, the margin call. His broker says, "You are under margin. Wire us $20,000 immediately or we will liquidate your position." He doesn't have $20,000 lying around. He is fully invested. So what does he have to do? He has to sell. He is forced to sell 1 or 2 of his contracts just to raise the cash to keep the others. And this is the trap. When he sells, he drives the price down. When thousands of traders are forced to sell at the exact same time, not because they want to, but because the rules changed. It creates a cascade of artificial selling pressure. The price drops, and when the price drops, more people get margin called. It is a feedback loop of destruction. It is a man-made avalanche. And, do you think this was an accident? Do you think the CME group just woke up and decided to raise margins for safety? No. This was a targeted assassination of the longs. They saw the open interest building up. They saw that the retail public was betting heavily on silver going to $100. They saw that the banks, JP Morgan, Citi, the swap dealers were trapped in massive short positions. If the price went to $80 organically, the banks would have lost billions. They would have faced their own margin calls. So, the exchange stepped in to protect the house. They raised the margin to force you to sell, so the banks could buy back your contracts at a lower price. They effectively shook the tree to make the fruit fall into the banks' baskets. This is the tamp down. It is the same dirty trick they used in 2011. It is the same trick they used in 2021 during the silver squeeze. Every time the little guy starts to win, they change the rules. They make it more expensive to play. But here's the detail that proves they are terrified. Usually they raise margins when volatility is extreme, when the price is moving $5 a day, but in late December, the price was consolidating. It was relatively quiet. There was no risk management reason to hike margins. The only reason to do it was strategic. They did it because they knew what was coming in January. They knew about the China export ban. They knew about the Venezuela tensions. They knew that come January 5th, the buying pressure would be unstoppable. So, they had to clear the deck before Monday. They had to flush out the weak hands now so the banks wouldn't get overrun when the real buying starts. It is a preemptive strike. They are trying to thin the herd before the stampede begins. And look at the timing. They did it right before the new year. They did it when volume was low, so the impact would be maximized. A margin call on a holiday week is brutal. You can't wire money easily. The banks are closed. You're helpless. It was calculated cruelty. But, and this is the most empowering part of the story, it isn't working. Yes, the price dipped. Yes, some people got liquidated. But look at the open interest. It hasn't collapsed. The diamond hands are absorbing the blow. People are wiring the extra money. They are selling other assets to meet the margin call. They're refusing to let go of their silver. And for those who are holding physical silver, this entire margin drama is meaningless. The CME can raise the margin to $1 million. It doesn't affect the ounce in your safe. You have no margin call. You have no counterparty risk. This dirty trick only hurts the paper speculators. It does not hurt the physical owner. In fact, it helps the physical owner, because by artificially suppressing the paper price, they are keeping the on-sale sign lit for a few days longer. They are giving you one last chance to trade your fiat for metal before the price reflects the reality. And let's be clear about why they are doing this. You don't deploy a nuclear weapon like a 20% margin hike unless you are losing the conventional war. If the banks had plenty of silver, they would just deliver it. They would say, "You want silver? Here, take it at $72. We have tons of it." But they aren't delivering. They are changing the rules to prevent delivery. This proves the inventory crisis. It proves that the registered inventory, the metal available for delivery on the COMEX, is truly bleeding out. We are looking at deficits of 200 million ounces globally. The bigs, the bullion banks, are terrified because if the price stays high, the holders of those contracts will stand for delivery. And if 10,000 contracts stand for delivery, that is 50 million ounces. The COMEX doesn't have 50 million ounces of registered silver. They would default. So they must force you to close your position for cash. The margin hike is not about market safety. It is about default prevention. They are breaking your legs to stop you from walking to the vault. So when you see the price volatility this week, when you see the sudden drops at 3 a.m., do not think the market is selling. Think the exchange is rigging. Recognize it for the desperation tactic that it is. They are trying to shake you out because they need your silver. Do not give it to them. But the margin hike is just the weapon. We need to look at the general who is ordering the strike. We need to look at the specific strategy being employed by the biggest player on the field. We need to look at JP Morgan because while the exchange changes the rules, JP Morgan is executing a very specific maneuver in the swap market to capitalize on the chaos. And there is a memo circulating, a leaked strategy note from Morgan Stanley that tells us exactly what they want the retail herd to do. They are telling you to exit, but we need to translate the banker speak into plain English. We need to understand what they really mean when they tell you to sell. Let's look at the bank strategy. Let's look at the exit memo. We have seen the weapon they used, the margin hike. But a weapon does not fire itself. Someone pulls the trigger. Someone gives the order. And to understand what is going to happen when the markets open on Monday, you have to understand who is sitting on the other side of the poker table. You have to understand the specific calculated strategy being executed right now by the generals of this financial war, JP, Morgan, and the swap dealers. While you're at home worrying about the price dropping, they're at work worrying about something much more terrifying. Extinction. They're currently trapped in one of the most dangerous financial vices in history, and their only way out is to trick you into opening the door. This brings us to the smoking gun of the weekend. There is a memo circulating, a research note from Morgan Stanley that was released to their high net worth clients just 48 hours ago. The headline is innocuous. It sounds like friendly advice. It says something along the lines of commodities rally overextended time to exit. They are advising their clients to take profits. They are saying the run to $70 was nice, but the fundamentals don't support it. Sell now before it corrects. Now if you are a naive investor, you read that and think, oh, the smart guys at Morgan Stanley think it's over. I should listen to them. They have PhDs. They know more than I do. Wrong. You need to learn to speak banker. When a major investment bank tells the retail public to sell, it does not mean the asset is going down. It means they need to buy. Think about it. Markets are a zero-sum game. For every seller, there must be a buyer. If Morgan Stanley wants to buy millions of ounces of silver to cover a short position, or to load up for their proprietary trading desk, they cannot just go into the market and buy. If they did, their massive orders would push the price to $100 instantly. They would blow up their own entry. They need liquidity. They need a massive pool of sellers to absorb their buy orders without spiking the price. And where do they find that pool of sellers? You. They issue a scary report. They tell you the rally is dead. They tell you to exit. They are trying to engineer a liquidity event. They want you to panic, sell your contracts at $72, so they can quietly scoop them up without moving the market. They are creating the very supply they need to consume. It is the oldest trick in the Wall Street playbook, the head fake. They point left, and they run right. If they truly believed silver was going to crash, they wouldn't tell you. They would just short it and get rich. The fact that they are begging you to sell tells you that they are desperate to buy. And why are they desperate? Because of JP Morgan and the swap dealers. These are the entities that make the market. They are the ones who sold the paper shorts to cap the price for the last 10 years. According to the latest Commitment of Traders report, the commercial category, which includes these banks, is net short by a historic margin. They are short hundreds of millions of ounces, and they are short at prices that are now underwater. They likely put on these shorts at $50 or $60. With the price now hovering in the 70s, they are bleeding. Every single dollar the price rises costs them tens of millions of dollars in margin calls. But the financial loss isn't their biggest problem. Their biggest problem is the inventory deficit we discussed in part 3. If they stay short and the price keeps rising, eventually the contract holders, the longs, will ask for delivery. The banks don't have the metal. So, they have two choices. Choice A, go into the open market and buy physical silver at any price to deliver. This would send the price to $200 or more, bankrupting them. Choice B, trick the longs into selling their contracts for cash before delivery time. They are choosing choice B. This is the strategy for the week. It is called the flush. They are combining the margin hike, the stick, with the bearish research note, the narrative, to create a moment of maximum fear. They want to drive the price from the $70 range back down into the 60s. Why the 60s? Because that is where their break-even is. If they can smash the price down to $65 for just 20 minutes, they can cover their shorts, exit the trade, and wash their hands of the danger. They can escape the trap, but they can't do it alone. They need you to help them. They need your stop-loss orders. They know that thousands of retail traders have placed stop-loss orders just below the psychological support levels, probably around $6.50 or $71.80. The banks have access to the order book. They can see exactly where your stops are sitting. It is like playing poker against someone who can see your cards. So their plan for this week is to use their algorithms to push the price down just enough to hit those stop-loss levels. Once they trigger the first wave of stops, your computer automatically sells. That selling drives the price down further, hitting the next wave of stops. It creates a waterfall decline. And who is standing at the bottom of the waterfall with a giant bucket? JP Morgan. They catch your selling. They cover their shorts. They escape, and you are left with a realized loss and no silver. This is why Morgan Stanley says exit. This is why the CME raised margins. It is a coordinated, multi-pronged attack to facilitate this flush. They are trying to engineer a bailout for the short sellers funded by your account balance. But here is the fatal flaw in their plan. Here's why this time is different. In the past, this strategy always worked because the only buyers were paper speculators. When the price dropped, the speculators ran away. But today, as we discussed in part 1 and part 4, the buyers are not just speculators. The buyers are China. The buyers are Samsung. The buyers are sovereign wealth funds. These buyers do not use stop losses. If JP Morgan smashes the price to $68, the Chinese industrial buyers won't panic. They will double down. They will see the lower price as a gift. They will step in and buy the physical metal that JP Morgan is trying to use to paint the tape. This creates a floor that the banks didn't account for. They might try to flush the price, but instead of crashing, they might slam into a concrete wall of industrial buying. And if that happens, if they try to smash the price and it doesn't break, then the banks are truly dead because they will have fired their last bullet and missed. They will have expended their energy trying to crash the market, only to find that the market is stronger than they are. So, when you see the headlines this week, treat them as a contrarian indicator. If they say sell, you hold. If they say panic, you remain calm. If they say the squeeze is over, you know the squeeze is just entering its most violent phase. They are projecting their own fear onto you. They are the ones who need to exit, not you. They are the ones trapped in a burning building, trying to convince you to trade places with them. We are watching a high-stakes game of chicken between the legacy financial system, the banks, and the new physical reality, the people in the industry. The banks have the algorithms, they have the media, they have the margin rules, but they don't have the metal. And in the end, he who has the metal makes the rules. So, get ready for the opening bell. Get ready for the moment where their strategy meets reality. Because Monday morning isn't just another trading day, it is the collision point. It is the battlefield where the algo flush meets the Shanghai floor. Oh, and we need to know exactly what to look for when that bell rings. We need a battle plan for the Monday open. We need to know the specific price levels that will determine the fate of this rally. Let's move to the tactical map. Let's talk about Monday morning. We are approaching Monday, January 5th, 2026. This is not just the first full trading week of the year, it is the collision point. It is the moment where the algo flush we just discussed slams headfirst into the Shanghai floor. And if you're watching the charts this week, you're going to see volatility that will make your stomach churn. You need a battle plan. You need to know the specific numbers that define the difference between a trap and a breakout. Here's the forecast for the opening bell. Based on the positioning of the banks and the margin hikes we just analyzed, we can expect the banks to launch their attack immediately. They will not wait for the afternoon. They will strike in the thin liquidity of the pre-market. Expect to see an immediate violent attempt to push the price down. They want to paint a big, ugly red candle right at the open. Why? To set the psychological tone for the week. They want the first headline you see on Monday morning to be silver crashes as rally fails. They want to demoralize the retail buyers who spent the weekend getting excited about the squeeze. They will use high-frequency trading algorithms to slam the bid stack. They will target the stop-loss clusters sitting just below $72. If they can punch through 72, they will gun for $70. This is the kill zone. This is where they hope to trigger the cascade of liquidation that saves their short positions. But, and this is the critical variable, they have to get past the Shanghai floor. While New York is trying to sell, Shanghai is waking up. And remember the premium we talked about, Shanghai is trading at $80 or higher. So every time the COMEX price drops to $72, the arbitrage gap widens to $8. That is an irresistibly juicy stake for the Chinese arbitrage traders. So while the JP Morgan algos are selling, the Shanghai arbitrage bots are going to be buying. They will be stepping in to buy the dip, not because they are diamond hands, but because it is free money. They buy the paper in New York, sell the physical in Shanghai, and pocket the difference. This buying pressure acts like a concrete floor. It absorbs the selling. It blunts the attack. You're going to see a war between the Western flush and the Eastern bid. The chart will look chaotic. It will wick down, then snap back up. It will look like a heartbeat monitor during a heart attack. So, what is your signal? How do you know who is winning? You need to watch one specific number. A number that has become the line in the sand for this entire bull market. That number is 82.67. Why this number? Because 82.67 was the recent high. It is the ceiling that the banks have successfully defended for the last 3 weeks. Every time the price gets close to 82.67, they slam it back down. They have built a fortress of sell orders at that level. They know that if the price breaks above 82.67, it triggers a technical breakout that brings in the massive hedge funds, the trend-following funds, the CTAs, don't care about silver or solar panels. They just follow the chart. If the price breaks the previous high, their computers automatically switch from neutral to max long. They will dump billions of dollars into the market in milliseconds. And that volume would overwhelm the bank's suppression capability. It would be the breach of the dam. So the battle this week is simple. The banks are trying to push us down to $70 to flush us out. The market wants to push us up to 82.67 to break them. We are trading in a range between the kill zone and the breakout zone. If you see the price drop to $71 or $70 on Monday morning, do not panic. That is the flush. That is the trap. If you have cash, that is your buying opportunity. That is where you steal the metal from them. But if you see the price start to grind higher, if you see it cross 78, then 79, then 80, Pay attention, because if we get a 4-hour candle close above $82.67, the game changes instantly. The flush will have failed, the banks will be overrun, and the path to $100 becomes a vacuum. There's almost zero resistance between 82 and 100. The price could move that distance in 48 hours. We call it a blue sky breakout. It creates a vertical line on the chart, a God candle. This is why the banks are fighting so hard right now. They know they are defending the last line of defense. If 82.67 falls, the citadel falls, and you have to watch the behavior of the Asian session specifically. Usually the Asian trading hours are quiet, volume is low, but recently the volume in Asia has been exploding. This confirms the takeover thesis. The center of gravity is shifting. If you wake up on Monday morning and see that the price rose during the night while New York was sleeping, that is the most bullish signal possible. It means the East is buying the inventory before New York even gets out of bed. It means they are front-running the Western Open. It tells you that the Shanghai floor is rising. So here's your tactical instruction for Monday. Do not set stop losses. I repeat, do not set stop losses. If you have a stop loss at $71, the banks will find it. They will wick the price down to $70, $90 just to take you out, and then rally it back up to $75. Do not give them that satisfaction. Remove the stops. Reduce your leverage if you have to so you can survive the swing. Or better yet, hold physical where stop losses don't exist. Watch the Shanghai premium. Keep a tab open with the